This one's might be a little bit more fun, actually, and it's called Fat Chance, Flat Phillips. And these are not the names of a tag team wrestling duo. It's the title of your August 31st post at Alhambra Investments. Jeff, the Federal Reserve has been wrestling with the relationship between inflation and employment. What's the problem, and how does this relate to our previous segment with Richard Clarida's speech?
Well, we're gonna go into Richard Clarida's speech, and we're going to actually talk about what it is that's happened and why they're, what does the background academic studies say? What are all the scholarly papers writing about? What are they trying to explain, and how this stuff is going on, and why are we getting into an average inflation target? What are they really trying to say here about full employment in the Phillips curve? The relationship between economic growth and tight labor markets and consumer prices and inflation.
Can
really,
you
it
just
starts again
very quickly, what is the Phillips curve? One sentence. What's the theory?
The Phillips curve is what we said before. It's a relationship between unemployment and inflation. That is simply that when unemployment drops down to a certain level, what we used to call full employment, that would trigger consumer price inflation because companies would compete for these scarce marginal workers. That would drive up labor costs, which then companies pass along to their customers in the form of sustained consumer price increases.
And Clarida said, okay, so we've pulled up a graph. Before we get to what Clarida believes has happened, what is this graph showing? Is it showing just exactly what we discussed?
It's a generalized, stylized graph of the basic concept of the Phillips curve, which is as people expect output to rise, they also expect inflation to rise. That's why you have an upward sloping Phillips curve. Okay. What had guided monetary policy into its rate hikes beginning in December 2015 was the ideas, the arrows that I have shown down below, that output was going to be rising because remember, they said the recovery is coming, we're at full employment, everything's good, therefore we have to start raising rates because inflation was going to be the big story in 2018 and 2019 and moving forward. You have accelerating growth, tight labor markets, the unemployment rate going down to its 50-year low, therefore guaranteed inflation. And of course, as we know now, we knew before, but as the Federal Reserve finally admits, that inflation never happened. Even though they spent years and years and years promising that it would happen, they're now saying, yeah, it didn't happen.
And the reason it didn't happen, both in 2015 and 16, when they first started raising interest rates, and then 2017 and 18, was because Clarida.
Yeah, well, Clarida's saying, again, we're starting from the premise that monetary policy works and that it created a recovery, but we got no inflation that would corroborate the recovery, rather than the simplest explanation, which is your premises are all wrong, the monetary policy didn't work, the economy didn't recover. Instead, we're still going to hold fast to monetary policy working, but then how do we explain how we didn't get the inflation that we all promised? Well, what they did simply was flatten out the Phillips curve. They are now saying, again, we're no longer going to define full employment, and the consequence of no longer being able to define full employment is something like a flat Phillips curve, which, as you can see from the darker blue line, what that happens under a flat Phillips curve situation is that as economic growth, as expectations for economic growth rise, as they said was happening in 2016, 17, and 18, it has very little impact on inflation because the curve is so flat.
And why did this happen? Richard Clarida must have offered an explanation as to why the economy transformed like this.
Yeah, and I think that's a big point here, Emil, because you can't just flatten out the Phillips curve because it's convenient to your argument. You have to give us a reason, because what you're talking about here is a fundamental shift in the economic forces, basic economic, real world economic forces. And so if you're modeling different types of scenarios where that would happen, there has to be something substantial that would change one of the most basic fundamental relationships in all of the real economy. And if you go back through all of the literature, I use an example of a Cleveland Fed paper that I used in the article I wrote here. I don't remember if Richard Clarida came up with his own arguments or if he was borrowing from them too. But when you go through those arguments, things like frictions and all these other economists gobbledygook, none of them are really compelling. And in fact, in the conclusions of a lot of these papers, they're kind of like, yeah, we're just throwing stuff at the wall and hoping one of these explanations stick, because we're really not sure. We really have no idea of how the Phillips curve could even become flat. And again, it's our main theme for this show is they're simply fitting data to their real world premise, which they refuse to acknowledge. It doesn't. Monetary policy doesn't work. And so, how do we reverse engineer an explanation from the central banks are central, monetary policy is effective, but we can't find any evidence for those things. So now they have to change all of these fundamental relationships, which is nothing more than unscientifically fitting data to predetermined conclusions.
It sounds a little bit like the explanation, this explanation. Why did the Phillips curve flatten? We're not really sure. It sounds a little bit like the explanation for the Great Moderation. They offered 3 explanations, but the last one, the most plausible one, seemed like just luck, happenstance. Not really sure.
Yeah, that's a really good point, Emil, because there's a lot of these things that happen, especially in the Eurodollar era, where they're trying to say, monetary policy, we really believe in it, but yet we can't really explain how it works. And that was okay. It was seemingly okay for a long time during the Great Moderation because everything seemed to be going really well. But as people were saying in the middle 2000s, especially with this enormous credit bubble showing up everywhere, there might be consequences to not being able to explain this expectations view of monetary policy and how it really is supposed to work and how it might actually work under less than ideal circumstances. When the monetary system does go awry, what do we do then? Well, central bankers have spent the last 13 years coming up with different explanations, not different ways of doing things.
And so if we look at your third graph, you provide that less than ideal economic situation as being the possible explanation, as opposed to a flatter Phillips curve. Of course.
Yeah, we don't need to flatten the Phillips curve because, again, all the evidence shows that the economy really wasn't accelerating. It really hadn't changed. And the reason there was no inflation, there was no inflationary outbreak and acceleration, was because of that. It's simply the Phillips curve has remained the same because you guys are wrong about the state of the economy. And again, if you scroll down a little bit more in the article, Emil, you get to the charts. I mean, right there, the bottom chart. I mean, look, does it look like there was an economic boom at any point since 2008? I mean, really, where is this inflation generating monster going to come from? There's no point along that way which would even remotely suggest exactly what Jay Powell came into office suggesting, that the economy was accelerating momentously into this inflationary recovery that we've all been waiting for. The simplest explanation, I think this chart sums it up best. Monetary policy doesn't work. And there's 2 parts of that. Look at where the deviation in the economy takes place in 2007 and 2008. What was 2007 and 2008? It was a monetary event. And ever since then, we've had all of these quote unquote monetary interventions that they never admit that these things don't work. They just try to repackage them, re-explain them. Always the same thing and always the same results, which gets us back to our new Fed's law derived from Murphy's law, which is monetary policy will never go wrong, so everything else will. And that's really what this chart says. It's when you think monetary policy is always going to work, everything else has to go wrong, and everything else has gone wrong.
I'm going to read the conclusion to your article because it has devastating implications for the reputation and professional pursuits of so many members of the Federal Reserve. Quote, "The only reason not to accept the results at face value is if you likewise can't accept the drastic implications behind what that means for central banks and their assumptions about the efficacy of monetary policies and how they actually work," as you were just saying. Jeff, that sort of wraps up the show for this week. Do you have any final thoughts that you wanted to share with the audience, perhaps about markets, where they're standing today?
Yeah, I think it's very interesting. One final thought is that, look, the Federal Reserve made a huge deal out of their grand strategy review. They wanted you to know they put a lot of time and effort into it, and that this was a massive change. As Richard Clarida tried to downplay, oh yeah, we were happy with monetary policy before, but we all know that's crap. We all know that you don't go undertake these major changes if you're actually happy. You don't just ditch full employment, a concept that had guided you for decades, if you don't think there's something majorly wrong with your worldview and your framework. So over the last couple months, they've been teasing out all of these things. We had the flood of liquidity, major QE, dollar swaps, all that stuff previously. And then on top of it, we have this massive change in policy. The Fed's going to let inflation go nuts. They're no longer the inflation fighter that we all thought they were since Paul Volcker. This was a huge deal, and it's been building and building and building, and stories in the media, this inflation thing, inflation, it's everywhere. And then it just fell flat, like the Phillips curve that they've tried to reinvent. It just fell, the markets kind of shrugged, even the stock markets were like, this is it.
What do you mean by fell flat? Like, and when you say markets, which markets?
Well, first of all, in the bond market, if the bond market was like, holy crap, this is really good stuff and it's going to lead to inflation, what would we expect to see in bonds? We'd expect to see a spike in yield. We'd expect to see, especially the interest rate swap market, completely change. Nothing happened there either. Even the stock market, which had been on this amazing, incredible run, it all seems to have peaked, at least in the short run, since Jay Powell spoke at Jackson Hole, and that it's really, the incredibly positive, in my mind, possibility that the news was the peak in the inflation cycle. That the market was saying, okay, this is a big deal. The Fed's really making a big deal out of it. Let's see what they have to say. Maybe they're going to come up with something really good this time. And he comes out with average inflation targeting, and the market just kind of shrugged its head. Both markets, stocks, bonds, interest rate swaps, derivatives, all these markets were kind of, wow, like they lived down to our worst expectations.
It has echoes of 2016's Bank of Japan helicopter money, when there was rumors during the summer that they were going to come out with something very serious in the fall, very serious. And so the market's kind of going, well, all right, let's take a look what's going to happen. And then the announcement, I believe it was in September of 2016, it was just, we're just going to do more of the same, except we're going to do it one louder. And maybe that's what's happening again. Markets gave them a chance, not too much of a chance, but a little, and now disappointment.
Yeah, and I think it's really important to contrast that with, as I was doing with Ed Harrison of Real Vision yesterday, the contrast, the reaction, go back to 2010 when they, Jackson Hole again, August of 2010, Ben Bernanke hints that the Federal Reserve is going to do a second round of major money printing. What happened in the stock market? The stock market went zooming ahead, went ahead for a very long period of time, went far ahead. In even the bond market, treasury yields rose nominally because the bond market was like, okay, maybe a second dose might actually work. There was a substantial reaction in most interest rate swaps, for example, same thing. Reactions in these markets that were like with QE2 that are nothing like we see today. Today, it's almost like did the Fed announce something? We heard they were going to announce something, but did they? And so to me, that's tremendously positive in a very limited sense. It's positive that people are no longer buying the crap. They're seeing these people for what they really are. They're just a bunch of charlatans and frauds waving their arms around, trying to make a big deal out of expectations, repackaging the same thing over and over again in a very unscientific way. And, the downside of that progress, though, is that, what do we do about it? We're still stuck with these people. And so, yes, it's good that more and more people seem to appreciate monetary policy for what it actually is. But yet we need to take the next step, which is do something about it.
All right. Thank you, Jeff. I will talk to you again next week.
All right, Emil, take care.